Hello and welcome to ABiQ's webinar for February. And I'm delighted to have with me online Mufti Ismail Dessai from GIFS based in Durban, South Africa. So Ismail has kindly agreed to give us a crash course, so to speak, in Islamic finance, project finance, focusing on that. And without any further ado, I'm going to hand over to him to take us through today's session.
Perfect. Thank you very much, Emil. Bismillah ar-Rahman ar-Rahim. Nahmaduhu wa nusalli wa nusallimu ala Rasulil Kareem. Esteemed management of ABiQ and respected audience, I greet you in the name of peace. Assalamu alaikum wa rahmatullahi wa barakatuh. Today's discussion will entail two segments. The first segment is in terms of a brief presentation on Islamic infrastructure and project financing. And the second session would be in terms of a Q&A session where you can pose your questions and we will answer them. The first session will be approximately 15 to 20 minutes, and the second session will be another 10 to 15 minutes. So without further ado, I would like to begin today's presentation. So if you look at our credentials, GIFS, or Global Islamic Financial Services, has been at the helm of Islamic finance for the last 10 years, and we have advised on various transactions, and we sit on various Sharia boards globally, including Hijaz Financial Services based in Australia, Botswana Life Insurance Limited in Botswana, the Ethica Institute of Islamic Finance, and we have advised various major institutions. In terms of products that we have developed very unique products, including Sharia compliant wildlife fund in South Africa. We've also issued various Sukuk, etc. In terms of the award-winning and landmark deals that we've done various deals, including the Dubai Municipality Sukuk. We've also issued a Sukuk for the Avani Halal Hotel in Dubai, and we've also issued various other Sukuk transactions. In terms of an executive background around unique products that we've developed, so we've developed a Murabaha stock leveraging product. We've also developed a factoring product, etc. In terms of our track record, we have 100% profitability in all our investment portfolios. We've done deal advisory of over $7.3 billion, where we've issued Sukuk, we've raised capital, we've done project financing, etc. And we currently have over $3.2 billion of assets under management. And we serve as advisor to 7 central banks and governments globally. In terms of the services that we provide, essentially we have 4 departments. Our first department is in terms of our investment banking division, where we raise capital, issue bonds, etc. Second department is in terms of our private equity division, where we manage close to $3.2 billion. Thirdly is we do proprietary trading, where we have an Islamic futures desk, futures and commodities desk in London. And lastly is we do financial services and wealth management. So basically, we are a bespoke and boutique investment bank and asset management firm based out of Dubai, the United Arab Emirates. Without further ado, and moving on to the next segment of today's discussion, and essentially the core focus of our discussion is in terms of Islamic infrastructure and project financing. So what exactly is Islamic infrastructure and project funding? So the definition of infrastructure and project financing refers to the financing of an economic unit, which is essentially a project with the underlying cash flows to service the economic unit in association with collateral. So what this typically means is that from a pure definition of infrastructure and project financing is that it refers to the financing of a project where we use the future cash flows to then service that economic unit from a financing perspective. Now, in terms of which projects can we use for Sharia compliant project and infrastructure funding? So we can use oil, mining, gas, PPI, roads, hospitals, etc. So some of the Sharia compliant solutions and techniques that we use include syndication, bridging, securitization in the form of Islamic bonds. We also have direct financing and co-financing. So we can also co-invest with other funds and funders into a project from a Sharia perspective. In terms of your asset classes, you're looking at a fixed income from a securitization bond perspective. And then you have hybrid, where we can have a mezzanine type of structure. What we've seen typically is that you could have a mixture between senior secured Sharia compliant term debt and some form of equity. And then you have your equity funds, where you have Sharia compliant infrastructure equity funds, etc. In terms of the vehicles that can be used, so you have Sukuk funds. So there are various Sukuk funds or Islamic bond funds. You have listed and unlisted infrastructure funds. And then you have infrastructure ETF funds that essentially track infrastructure funds. So what are the key concepts that back an Islamic infrastructure, funding structure? So you have the Mudaraba structure, which essentially refers to a sweat partnership, where you have the funder that provides the capital, and then you have the operator or the project promoter that essentially is the working partner or the sweat partner. So this is termed as a Mudaraba, or in other words, a sweat partnership. The second concept is what is called a Wakala, which is an Islamic investment partnership, where essentially the project promoter, the project promoter is provided with a mandate to essentially invest the funds in Sharia compliant projects. The third is what you have is called an ijara. And ijara refers to where the project is essentially based on a sale and leaseback. So let's say, for example, you have an asset where the government, for example, or the sovereign or the quasi-sovereign, for example, has different assets. They would then sell it to the Sukuk fund. The Sukuk fund or the Sukuk SPV would then lease it back to the government for fixed payments, and the funds that it has received that could be used then for project and infrastructure funding. The Ijara and Wakala model perhaps are one of the most commonly used Islamic infrastructure and project funding models, where you have various Sukuks or Islamic bonds that have been issued on that basis. And then you have Kafala, which is an Islamic guarantee. And essentially it is where you have a third-party guarantee, almost sort of an insurance cover that protects the investors. And you have various divisions within the Islamic Development Bank, for example, ABiQ, which provides Islamic Takaful or Islamic insurance, Islamic insurance cover to protect the investors. And essentially, we have a structure at GIFS at our firm where we can take a sub-investment grade project to an investment grade level. Then you have the Murabaha structure. So the Murabaha refers to essentially where it is the purchase and sale of a project. And then you have the Istisna, which is essentially an Islamic manufacturing concept. And the way the Istisna works is that you, as the project promoter, basically receive funding to then produce an asset, and then that asset essentially is then sold to the obligor, which is the government, and then the government then provides lease payments for that project. So this is also a key concept in terms of Islamic infrastructure project. We will come to specific diagrams around the Istisna, Ijara, etc. In terms of security, so while Islamic finance and Islamic financial structures are asset-backed, they would also have security. So in the event that there's a default, then the security would then be deemed to be part of the common security pool, where the Islamic investors would have access to the security. In terms of kafala, where there's an Islamic guarantee, so obviously, as I've mentioned, that entities like ABiQ, as a division of the Islamic Development Bank, provides the Islamic guarantee to then guarantee those structures. Now, what are the key issues that are facing Islamic, project and infrastructure funding? So the key issues include default. What happens if there is a default by the project promoter or the originator? So in the event of a default, there would be a penalty imposed that can be dispensed off into charity. because in Islamic finance, or according to Sharia law, you cannot charge interest. And then secondly, is from a taxation perspective, certain jurisdictions allow for tax parity from an Islamic finance perspective. However, what we've seen is that those jurisdictions that don't have Islamic tax planning, in that instance, or Islamic taxation laws, in that instance, you can make a special submission to the government or to the tax authority to get parity in terms of Islamic finance or Islamic taxation. The other issue is in terms of hedging. So yes, there are Sharia compliant hedging mechanisms like Sharia compliant, swaps, etc. So this is key, especially when investing into non-USD or non-hard currencies, like for example in the South African rand or the Botswana pula or other currencies. Then also there is the issue of intercreditor agreements. So Sharia law allows for intercreditor agreements because we understand that there are various parties at play. And then together with that, obviously, is that in the Sharia structure, that there would be a Sharia audit of the Sharia SPV that is then established. So this is basically some of the key issues around Islamic project funding. Now, I'd like to provide you with some examples of Islamic infrastructure and project funding. So you have Aldar Properties in the UAE that issued a Sukuk. Emirates Airlines issued a Sukuk via the SPV called Wings FZCC. And this Sukuk, we were involved with the global law firm Linklaters. The Nigerian sovereign Sukuk, or the Nigerian sovereign Islamic bond, was issued essentially to fund the road infrastructure in Nigeria. You have the Ivory Coast sovereign Sukuk that was also issued, essentially referred to as a cocoa bond or a cocoa Sukuk, that was used to fund the cocoa industry. And then very interestingly is you have the Bangladesh water Sukuk that was issued recently. And this Sukuk has been oversubscribed. And essentially the Sukuk was used to fund water infrastructure projects in Bangladesh. With that, I'd like to take you through a brief history of Islamic finance before we go into some of the key structures for Islamic finance. So Islamic finance was essentially established during the prophetic era, during the time of our Prophet Muhammad sallallahu alaihi wasallam, may peace be upon him. And we had different structures like the Sayarifa, the Islamic money exchanges. You had the Baytul Mal, the public treasury. You had Zakat, which is an Islamic, alms or tax paid on a yearly basis at 2.5% of your zakatable wealth. And you had Islamic monitors that would then review the market to ensure that one is conducting the affairs in a Sharia manner. Thereafter, you had a lull in terms of Islamic finance, and you had perhaps the earliest development of Islamic finance in the early 1940s, where a group of peasant farmers in the north of Egypt, pooled their funds together to then set up the Mitghamar Savings Project, which essentially has then transformed into what is today known as the Faisal Islamic Bank, which is a national bank managed by the Egyptian government. So this was all born out of a clear intention by these peasants and farmers to earn a Sharia compliant return. Then you have the first bank that was established, the Dubai Islamic Bank, which is today the largest Islamic bank globally, that was established in 1974, 1975, and the Islamic Development Bank, which is an Islamic multilateral institution. Perhaps an earliest example of a Sukuk was issued by the Ottoman Empire in 1885, and you have various, Islamic, funds, including the Tabung Haji, which is a Hajj fund, or the annual pilgrimage Hajj fund issued by the Malaysian state. As you can see here, this is a very clear snapshot in terms of the development of Islamic finance. As you can see, prior to the 1970s, we had retail banking. Going on to the contemporary 2000s, you now have advanced treasury services and products. Now, what is the source of Islamic finance? So Islamic finance is primarily derived from four sources, which is the Quran, which is the primary source of the Sharia law. We have the Sunnah, which is the practices of the Prophet Muhammad. You have the Ijma, which is consensus, and we have Qiyas, which is the analogy. And there you can see the Sharia structure in terms of the application of Sharia law. In terms of Islamic finance and conventional finance, So Islamic finance is essentially banking in consonance with the value system and ethos of Islam and governed by the principles and maxims laid down by the by the classical Islamic Sharia law. And the fundamentals, as you can see, in terms of Islamic finance is that it is asset-backed. There is a prohibition of interest. There is a prohibition of certain activities like sinful activities, etc. There is a prohibition of gharar, uncertainty, and maysir, gambling. There is also the concept of profit and loss sharing, only in certain concepts where the bank will act as an agent on behalf of the depositor, and the depositor is then also entitled to a gain or loss of that investment. These slides perfectly, describe Islamic finance and banking in terms of the principles, including risk sharing. Perhaps one of the major differences between Islamic finance and conventional finance is that in Islamic finance, money is not meant to be an asset of value. Money is simply meant to be a medium of exchange. So one cannot earn money on money. Money is just used to create value. And secondly is Islamic finance and banking is backed by real assets or services. So perhaps Islamic project funding and infrastructure financing is one of the most prudent aspects or suitable projects that could receive Islamic funding. If you now look at the next slide, it perfectly describes the activities of an Islamic bank. As you can see that you have investment coming from depositors, you have money market accounts, and then you have financing. These are this is in terms of the Islamic investments, in terms of liabilities, in terms of assets, and then you have the liabilities on the financing side. And then you have shareholders and depositors on the asset side that will fund the Islamic bank. Going now into the main concepts of Islamic finance. Essentially, there are three main concepts of Islamic finance. You have the equity-based, which is mudaraba and musharaka. You have the trading-based, which is istisna and murabaha. Then you have the lease-based, which is ijara and ijara muntahiyya bit-tamlik. So I'll now go through these concepts fairly quickly. The first is in terms of musharaka. So what exactly is musharaka? So musharaka comes from the Arabic word which means sharaka yushariku, which refers to where two or more parties share in an investment. So two or more parties contribute capital towards a joint venture. As you can see from this diagram, that the profits can be based on an agreed ratio. So whether it's 60-40, for example, but the losses are based on the capital ratio. So if partner A contributed only 60% of the capital, then his loss should only be 60%. That is how a musharaka works. The difference between a musharaka and a mudaraba, which is an Islamic sweat partnership, is that in an Islamic sweat partnership, one party only contributes the funding, but the other party only contributes services or investment management. So this perhaps is a very clear, concept and an example where Islamic, project funding or Islamic infrastructure financing could use mudaraba for different projects and to finance different projects. And as you can see here again, that the Rabbul Mal, who is the financier, contributes the capital, whereas the mudarib contributes services. There are different products that are used for mudaraba. So for example, you have the private equity fund, you have deposit accounts, project financing, import financing, export financing, etc. The next slide refers to what is called a murabaha. So murabaha refers to where the selling price is known to the buyer. So it is basically finance. It is cost plus financing as a concept. So an example of murabaha is where the bank purchases the goods from the supplier and sells it for a markup to the customer. So instead of providing a pure term loan, an Islamic financing is based on an actual purchase and supply of an item to the end user on terms. So it's not an Islamic finance loan per se. It is essentially an Islamic trade where the goods are bought and then sold. This diagram perhaps provides one of the clearest examples or diagrams to show the differentiation between conventional banking and Islamic banking. So as you can see, that on the Islamic banking side, you have the purchase price, whereas on the conventional banking side, you have the amount financed, and then you have the interest rate. But on the Islamic side, you only have an installment. The next concept is what is called the ijara. Ijara is simply an Islamic lease. So as you can see, that the item is purchased or the asset is purchased, it is leased, and then there is a bullet payment at the end where the client then purchases the asset. The next concept is in terms of salam. So salam refers to salam financing, which is essentially an Islamic forward sale. So let's say, for example, the Islamic bank wishes to finance a sugar mill. They would then provide funding to the sugar mill, and then when the sugar is ready, then they would then immediately sell it to the off-taker as part of the financing arrangement. The next concept is what is called a takaful, or which is Islamic indemnification. We'll go through this very quickly, but essentially it refers to an Islamic indemnification structure similar to a mutual co-op. The next concept is what is called Sukuk. So Sukuk refers to Sharia compliant financial instruments, and it is linked to underlying assets representing partial ownership in the asset. Generally, we translate this as an Islamic bond. And as you can see, the global Sukuk market is increasing. In 2019, the market stood at $160 billion with a 14% year-on-year growth. In 2020, we saw a growth actually in terms of Islamic Sukuk financing. So in 2020, Islamic bonds were issued close to $172 billion. So despite COVID, we still saw growth of Sukuk issuance. And this year, we should see an even more higher growth in terms of Sukuk funding globally. So what are the main rules of Sukuk funding? So the funds must be raised for Sharia purposes. The funds must be used for tangible assets, and the Sukuk holders would have a right to the ownership of those assets. And there is no financial guarantees, and the assets need to be screened for Sharia compliance. The next slide essentially shows a clear diagram of a Sukuk. So let's say, for example, we have a road project that requires funding from a Sukuk perspective. So how do we fund it in a Sharia compliant manner? So essentially, you would have a Sukuk SPV or an issuer SPV. Now, the reason why we generally have an SPV or Sharia SPV is for two things. One is so that we can ring fence the funding, and secondly is so that we can have essentially we can ensure that all of the activities are Sharia compliant. So there is no potential for commingling, and also that from a Sharia perspective, that these funds will then be ring fenced in what is termed as a bankruptcy remote vehicle. So let's say in this instance, the investors would receive a Sukuk certificate. They would invest into the SPV. The SPV then invests cash into a Musharaka project. So where you see the diagram saying Musharaka, that refers to the Musharaka project. We then have the originator. So the originator is essentially the promoter of the project. The company or the entity that has received the contract to deliver the roads. So the originator as a partner would then essentially contribute, let's say, the land for the project, or the contributor or the originator contributes cash to the project. So let's say, for example, the investors would contribute 80% cash, whereas the originator contributes 20% cash, for example. And then you have the Musharaka project that then provides a share of the profit or loss to the SPV, and you then have the investors receiving either the proceeds, or they would undertake the loss. You then have at the end of the maturity, where the project is then sold to, for example, a government that wishes to purchase the roads, etc., or to a quasi-government entity that purchases the units of the Musharaka project. And then there is an excess price, and the investors receive the returns. Also, as part of this, you would have a managing agent, sort of like a wakil or an agent, that will receive a fee to manage this entire process. So that is essentially how a sukuk works. You have different forms of sukuk. You have musharaka sukuk, ijara sukuk, murabaha sukuk. You also have a wakala sukuk and a sukukul istisna. Now, I want to discuss the sukukul istisna a bit more because I believe the sukukul istisna or the Islamic, manufacturing or infrastructure, bond concept is more applicable here. So essentially, you'd have the investors that would invest in the sukukul istisna. The funds will go to the contractor. So, for example, let's say you have an ECP contractor that is contracted to produce an asset. Let's say, for example, a wind or solar farm for a particular government. They would then produce that asset and then sell it to the SPV as the investors. The investors would then lease it to the government, for example, and then at the end of the term, the government would then purchase that asset. So that's essentially how a sukukul istisna would work from a securitization perspective. We now move over right to the end of today's discussion. So the big question is, we've discussed, the different Sharia compliant mechanisms of raising capital, etc. But how do we raise Sharia capital? So we at GIFS have been raising capital for the last 10 years. We've successfully raised billions of dollars in funding. And primarily, we see funding coming from several entities, including Sharia compliant equity and sukuk funds, banks, family offices, the Islamic capital markets where you can issue an Islamic bond or sukuk, and also from multilateral development banks or the DFIs. So for example, you have DFIs like the Islamic Development Bank, etc. And then the major stakeholders in an Islamic project funding exercise includes the legal advisors to make sure that all of the structures are legally compliant and the investors are protected. Then you have the tax advisors, basically to ensure that from a tax and auditing perspective, that everything is put in place. And then you have the Sharia advisors that will advise on the project, and you'll have certain consultants also involved. And then you'll have the banks or investment banks that will then raise the capital and provide the funding. In terms of the typical roadmap or process, essentially, the roadmap would take approximately 6 to 8 weeks if it is a fairly simple project. More complex projects would take about 2 to 3 months. And essentially, the process would include mandating advisors, including the Sharia advisors, to then review the project documentation, also to engage with the underwriting parties, like investment banks and banks, to then underwrite the issuance. And then, essentially, once the documentation has been settled, that you have the prospectus or the private placement memorandum for the funding to then be raised. So as I said, in terms of GIFS, we as a firm, we do the entire process in terms of structuring these Islamic bonds or project financing transactions, and we also raise the capital. So this is a unique aspect of our firm in that we combine both Sharia knowledge with technical expertise in terms of raising capital. Lastly, before I terminate the first session of today's presentation, is that I would like to offer you a free copy of our ebook called Your Brief Guide to Islamic Finance. And you can download this from our website, www.gifsrv.com. You can also follow me on Twitter. I go as MFT Dessai, MFTDESAI on Twitter for updates on Islamic finance. I am also on LinkedIn and Facebook if you wanted to follow me for further updates. In saying that, I'd like to now open the floor for question and answers. And I'd like to hand over to Emil to then direct that. Thank you.
Excellent. Thank you very much for that, Ismail. We've got a couple of questions listed already. The first one is, may you elaborate on Islamic tax? What are the core basics there, and how is it different from traditional tax?
So typically, the taxation, refers to certain core elements especially in terms of the sale and leaseback or sale and purchase or buyback of assets. From that perspective, what we've typically seen is either one of two things. One is where we've seen a session take place rather than an actual sale and leaseback to prevent double taxation. And in certain instances, scholars have allowed for this simply because there isn't the current jurisdiction and taxation and favorable taxation laws for Islamic finance. And this is what we have proposed. Secondly is you have certain jurisdictions that would allow for tax parity around this. So as long as the fundamental is in terms of the asset belonging to the balance sheet of an originator, essentially, even if there is a sale and leaseback, as long as there is proper guidelines in terms of documentation, etc., then the tax authority is happy to provide a favorable ruling in that regard. Now, this is just simply one example. Like that, there are many other examples. So from a tax perspective, as I mentioned, is that where there isn't any taxation laws, then Sharia scholars are more flexible around which structures can be used, not differing from the Sharia compliance of the actual structure, but simply in terms of accommodating, the requirements based on the current, realities on the ground. Okay.
Excellent, thank you. And then also there's a question in terms of from GIFS's perspective. Have you been involved in any PPP or BOT projects in rail or infrastructure projects?
Yes, so this is a very good question. We've been involved in a number of transactions from a BOT, build, operate, transfer perspective in terms of funding Sukuk transactions for various infrastructure financing. So for example, we have done a Sukuk project in South Africa for the development of social housing, which is a huge issue in Africa. We've also done a Sukuk project for agricultural funding in Ghana. And like that, there are many other projects that we've worked upon. So we do have the relevant expertise in doing this. By the way, we did a small Sukuk issuance of $6 million 4 years ago for a hospital with an Islamic ethos based in South Africa. So these are a few examples of what we have done in this space.
How would you do it just curious in terms of agriculture? How do you do, I mean, obviously we talked about the SPV and the assets, but I mean, normally agriculture is a difficult one to ownership of land and so on. How would that work?
So this is a very interesting question. And perhaps it's something which hasn't been more touted, readily in capital markets. So essentially the way the structure would work is you would essentially have a government that would capitalize a lease, sell that lease essentially to the Sukuk SPV, and then you would then own the rights to that SPV, and then lease those rights back to the government in one part, and the second part is then to have a sharecropping agreement with the state with an off-taker. So the state would then essentially provide you with a guaranteed off-taker for the grains, and then that off-taker would then be guaranteed by an Islamic indemnification product where there's blanket cover and BIGA World Bank insurance, for example. So it was quite a unique project, but it was something also that investors quite liked because the average return profile was higher than your normal Sukuk, and given the fact that it was backed by a state, and you had one of the largest mills or grain mills that was involved in the transaction, where we had adequate security and adequate collateral, investors were fairly happy to do such a transaction.
Okay, I think that's quite fascinating. What about healthcare projects? Yeah, I've got a question here just in terms of maternity hospitals where there's kind of the government provide a free service. So how do you, how would that typically work? Because now it's not a profit-making entity, or in the traditional sense of the word. Do you get involved? How will it work?
So that's a very good question. So essentially what we do is we typically get a service level agreement from the government where we essentially develop the project. The government essentially provides us with lease payments. And at the end of the term, there's a bullet payment where the government pays one bullet payment and takes over the hospital. So essentially, while the actual project itself is not profit making, because there's a government that backs the project, they would then provide lease payments. So over a period of 10, 15 years, they would buy out the project from us by doing it on a sale and lease back structure.
Okay, so that is actually quite doable then. So I think just in terms of comment about the presentation, you are happy for us to distribute it to all participants today?
That's perfectly fine.
Okay, so we will certainly make sure that happens. And then also, I think I would like to, you know, I know you're one of our guest speakers at our event coming up on May 17th here in Dubai, looking specifically at PPP opportunities in Africa.
Sure.
So just for the audience as well, make sure you get here, get involved. If you have any projects that's requiring finance and you need to connect with Ismail, you'll be here in Dubai, as well as representatives from many of the other large investment funds as well. So that's just an open invitation as well. Back to a couple of questions. Another question. So if it's a charitable foundation that owns the hospital and it's not government, how will that work? I assume it would operate on the same basis. Someone's going to make the lease payments.
Yeah. So look, in terms of a charitable you know, operation, what we have is you have various Islamic endowments and the like that don't necessarily require a profit motive in terms of funding a transaction. But what they would like to see is some form of project ownership by the government, where they would fund a project, get the capital back. So it could be sort of in the form of a zero coupon bond, where the government pays back the actual amount that was disbursed. Yeah. This in actual fact is a very strong mechanism for funds and major endowments and charitable institutions to then partner with governments to fund such projects where, you know, they use the capital effectively, but then they then receive the capital back to then go into more projects.
Okay, that's good. And I think there's obviously a lot of opportunity for that across the African continent. I mean, we've seen many instances where charitable organizations are trying to get involved, especially in the healthcare side. And I guess post-pandemic, or we're still in it, big need. So, I mean, I think the contact details are all there for anybody that would like to find out more. I've got one more question just in terms of, and I think you might have kind of addressed it already, but I'll just throw it out there for that maybe some of the latecomers, is just how does Islamic finance differ or complement project finance?
So essentially, Islamic finance, the way I normally describe it in practice, is that it's 95% is conventional and 5% Islamic. So Islamic finance is seen almost as a wrapper around conventional finance. Obviously, the mechanisms differ. And I'd like to explain this by two examples. The first example is that there are two chickens. They both look alike, but why is it that one is halal and one is not halal? One is Sharia compliant, one is not Sharia compliant. The answer to that is because on one, the name of God was taken, and on the other, the name of God was not taken. So although they look alike, and they certainly you know, look like there is no differentiation between the two, but one is halal and one is not halal, it's because of the mechanism that was reached to make it halal. That's the first example. Another example of this is, you know, you have two buildings. One building is a strong building and the other is a weak building. Why? Because the one has a strong foundation and the other has a weak foundation. So Islamic finance, you know, is based on principles that differ from conventional finance. So, you know, when we talked about the fact that money is only a medium of exchange in Islamic finance, you can't make money on money. So essentially that reverts to then that from an Islamic finance perspective, every transaction has to be asset backed. So you either invest in a project or you invest in an actual asset, and that asset produces a return for you. So you cannot charge interest. That is why when you talk of an Islamic coupon, we don't talk of Islamic interest, or we don't talk of interest. We talk of an Islamic profit or an Islamic, coupon or Islamic Sukuk coupon that is paid over to the investors.
Okay, excellent example there. Another question, is GIFS selective in terms of the income status of a country where the projects may be funded? And does political stability or democracy play a role in funding of these projects?
So look, this is a very good question. Obviously, when it comes to third world countries, where we do have a lot of exposure and expertise, with boots on the ground in Africa and in certain other jurisdictions, in terms of third world countries, is we generally take out, MEGA.
Yep, it looks like we have lost Ismail there. I think we've had an excellent event, and we'll see whether we can get him back online, whether he joins shortly. Otherwise, we will conclude today's webinar now, and we will make sure that the presentation is available online to download from our website, and then also the video will be posted within the next day or two. So once again, thank you for those that joined us today, and I'm hoping that we will have you back next month for another episode of ABiQ's webinar focusing on project opportunities in Africa. Thank you and goodbye.